Hi everybody, this is Hustle Hub. I'm Giacomo. Today we have a special guest, Nicholas Pardini. He has his own channel, Analyzing Finance with Nick. Nick, please tell us a bit about your background, what you do, and why you decided to start a YouTube channel.
My name is Nick. I run an investment research firm called Davos Investment Group. We specialize in finding a lot of the unquantifiable risks in marketplaces and how to help institutional investors capitalize on those. Uh, Prior to starting Davos, I worked on the buy side for 10 years at various investment firms, mostly hedge funds. And the reason I started my YouTube channel is because I kept getting questions from a lot of the more laymen and compared to finance professionals about what's it like to be on Wall Street, what are some things that are going on in the financial markets that make logical sense or not logical sense, and it's kind of my way to give back to the community. I mean, I don't really expect to it's going to do the niche level of the topic, become a full-time YouTuber, but when I do have something to share or I get questions from my audience that people find of interest, I feel free to dispel some helpful commentary.
Okay, nice. Can you tell us a bit about your background, why you wanted to go into finance, and how you got there, and what is your track record from your first jobs in finance to what you do right now?
Um, when it comes to why I decided to get in finance, when I went to college, I didn't really know what I wanted to do. I just knew that I eventually wanted to work for myself by the time I turned 30. Other than that, I really had no idea how I was going to get there. I had a very naive view of the world when I was 18 years old. And then I did a mentorship slash internship for a local family office near where I went to school. And I learned that trading is not something just like that retirees do with all the money they saved at their normal job. You could be paid to manage money for other people or provide advice to people in that space who are bigger active traders. And you can do that as a career while you're younger as well, and not just because I always thought, because I learned how to invest in stocks from my grandparents, truly my grandmother. And I always thought it was something you do once you've saved a bunch of money for something else and you do it as a retirement. But I didn't realize that people actually there was like beyond like a few mutual funds in Boston that there was like a whole bigger profession behind this. And then when I did, um, now when I even heard about hedge funds back before I actually worked under a hedge fund manager, I thought they were just like doing what I would think is now private equity only. But that was a mistake I learned when I was in college, and then I realized, hey, you can actually be involved in the public markets at a much younger age professionally. So I was like, this is why I want. So I think this is what I want to do. And I graduated, unfortunately, from college in the wake of the financial crisis. So it was very hard for me to break into the buy side. In fact, my first job was more of a back office type role, which I didn't stay super long because I didn't see a trajectory there for getting what I wanted eventually. So I ended up going to graduate school and starting the CFA program. And then after that, I did worked at various buy side firms until I started my own firm in the end of 2017.
Okay. Can you tell us a bit more about your firm and what you offer to your clients? What are they like? What are the kind of clients you serve, and what are the services that you offer where you stand out the most?
Yeah, I mentioned it in the introduction earlier, but kind of where we stand out is that we have a lot of work. My primary focus is global macro, analyzing the top-down situations, not both just like on general economics, but also I try to narrow it down to more niche sociocultural trends, which may be capitalized best off an individual stock versus just trading a currency pair or an index. So that's one way we're a little different. The other way that we are different is that I can integrate both traditional value and top-down macro analysis with my background in volatility. Because the last place I worked at before I started my own firm was a major options volatility focused hedge fund. So I got a knowledge of being able to integrate a lot of what's going on in the options market versus the more traditional directional aspects of trading. So it's a way I can figure out basically how to get the best risk reward using a mix of derivatives and underlying in terms of how I would advise my clients, which are institutional investors, hedge funds, family offices, long only asset managers.
Okay. Can you tell us a bit more how the approach changes from an equity trader to a derivatives trader? What are the skill set that you need to have as a derivatives trader, and what are the main differences in working on derivatives compared to equities?
Well, just to note, the derivatives market, especially equity options, are fairly efficient. So even if you find a good directional trading opportunity, well over 50% of the time, you're going to be better off trading the underlying than the derivative. It's just that when volatility, the main difference between equities and derivatives is the time limitations of options. Because options have a shorter period towards expiration, a lot of the price of the option is not just the directional move of the stock. It's also other variables which are known as the Greeks. I did a video on this on my channel where there are things such as the time length of the contract, the implied volatility, which is how much the market expects to move, and those changes actually in those indicators often move the option more than what it would be for the actual price. So you have to look at delta, which is the Greek, and the change of direction, change of price. It's not one. If the option moved the exact same amount as the stock, the delta would be 1. But most options, unless they're really deep in the money, the delta is not 1. And at the money options, it's 0.5, and then it moves depending on how far away the market is. And options also generally are good measurement of probabilities. They are the way that especially if there's a key catalyst or event that's well known, you can use the option market to analyze the probability of a certain event happening one way or the other, given what the move is implied versus if you have an expected endpoint. Like I try to help my clients find what these expected endpoints are in various given scenarios. But yeah, I don't exclusively do derivatives, but those are some of the main differences that you have to factor in other variables, just the price. And then also if you can, the other thing you can do is you can sell derivatives, which are basically, you're not betting on when you sell options, the stock going down like a short sell, because you can have puts for that. It's more that you're betting on the variance or the movement of the underlying security to be less than expected.
Okay. So you're basically saying that usually derivatives are better priced compared to equities and are more efficient, right? Or is it?
It's not. I think that the efficiency of derivatives are different. Yeah, from a volatility perspective, I would say that the derivatives market is more often than not more efficient. For the options market, unlike the equity market, somebody always has to take the other side of the trade.
Okay.
And so if say for example you buy an option or sell an option, there's going to be a professional market maker who's going to be taking the opposite side, and they're not going to take that trade unless they think it makes sense. Sometimes they don't get right all the time, but that has something to do with why the options market would be more efficient.
Can you tell us a bit more about the tools that you use for this kind of analysis? And in one of your videos, you talked about why it's not always necessary to have tools like a terminal. And can you tell us a bit more about how you find your information without the terminal?
Yeah, I mean, when it comes to a Bloomberg terminal, I think if you are a firm that is large enough where it makes sense to buy one, it probably does make sense to buy one, assuming what you're doing. Like if you're doing deeper dive research in less liquid assets such as derivatives or off the run bonds. Whereas there's a lot of alternative data sources that are useful, especially in the equity space. Uh, there's several competitors out there to Bloomberg, such as Y Charts, Cintio, Koifin, and they're at various different price points, and they're different depending on what type of research you're doing. Some are better if you want to dive into 10Ks and look at more qualitative factors. Others are better if you just want a more better way to visualize data. So it really depends. I also like to read Seeking Alpha quite a bit, mainly to try to find the contra perspective to whatever position I'm considering putting on. It's also a reason why you'd want to talk to sell-side research analysts too. So that you can understand what you're missing in your thesis, or if there are any material facts that you may have just not know about or just skipped your research process. Yeah, and then I have various RSSs that I subscribe to and news outlets that they are fairly objective or cover like a certain space that I don't think the mainstream press does very well. And there's a variety of sentiment indicators I look at as well, because as the valuations continue to get more detached from historical averages, the market moves more based off of emotional and sentiment variables.
So, um, so let's talk a bit about your investment strategies and what did you learn with all the experience that you had in the different funds. What did you learn that you didn't get the chance to learn on books in university?
Well, I mean, I learned quite a bit through undergraduate and my graduate program and through taking CFA exams. But when it comes to what I learned, a lot of that is more theoretical. A lot of stuff I learned just through my internships and jobs I've had. One is, first of all, again, a lot of the vol space. I mean, you learn about derivatives in theory, but you realize like the options, they look cheap, but the fact that your time, like the first options trade I ever did was buy a put on a tech company, and the implied volatility for 6 months out, and the value of the option was about 20% of the stock. And I bought this, and I was right. The stock went down 20%, but since the implied vol was implying that much, I made nothing on the trade.
Okay.
And that was a hard lesson to learn. The other thing you learn is risk management more, because when you're managing other people's money or you are working on a team that's managing other people's money, you don't have the same flexibility that a lot of these people who invest like in Bitcoin, for example, to see your portfolio go down 50% and not break a sweat. Like you have other people counting on you to have fiduciary responsibility. And the key really for professional traders is not necessarily hitting home runs every time. Think of it like the greatest traders probably have about double the success rate of the greatest baseball players in terms of their batting averages. Like if you're hitting 60%, you're an all-time great.
Okay.
The thing is that when you're wrong, how much money do you make when you're right versus how much when you're wrong? That ratio is key. Like there's plenty of macro traders that I know that maybe hit 40% of the time, but they're making 2 to 3x the amount of money on the trades that they're right versus the ones that they're wrong. So they're making money on the aggregate. And a lot of people just don't factor downside risk correctly. And they also don't realize that every trade is directly or indirectly a volatility trade, whether you're buying vol or selling vol. And whether you look at it what if you are a net shortfall, that's usually, and if you're not, and you don't realize that you're net shortfall and don't size your position properly, that's how most people fail in this business and blow up.
Okay. So, in another of one of your videos, you talked about how people get trapped about in dividend investing, and they chase dividends and don't look at the quality of the company. So, what is your take on that? And how how what is a better strategy compared to that? What is your take on that?
I said it in the video, what my strategies were really on that is that if you're going to buy a stock with a high dividend, you need to be very clear why there's a high dividend. And once you figure out that, do you think that it's because just of market sentiment and people being overly pessimistic on a sector, like say like they were about energy this time last year? Or is it because there's a real risk that the company is going to be impaired or it's a melting ice cube? Like, for example, a company that would sell buggy whips when the car was invented. Yeah, it may pay a great dividend, but there may not be a company for a while, so it's not going to be enough years for you to recover your investment. There are value bet guys who do something called a cigar bet strategy. It's not as popular now just because yields are low everywhere. But when yields were higher, a company would have a very high dividend because people would be afraid that the company's product would be obsolete and not exist anymore. But as long as you got enough dividend checks that end up being worth more than the company before it ultimately shut down, you still won. So you've got to do an analysis on why the dividend is it because the company is in trouble, or is it just because the market just hates a particular sector for a reason that you don't agree with? And because usually when these dividends are high, the market is sniffing something out, and you have to figure out what they're sniffing out, and if they are sniffing out something, are they right about it, or are they wrong about it? And if they're wrong about it, then there's an opportunity, and if they're right about it, you got to stay away from that and find something less risky.
Okay. So, one thing that I've been talking about a lot on my previous interviews is data. So, if you're so in a job like yours where you do research for companies, are you looking for alternative sets of data, and why are hedge funds investing so much in these alternative datas?
Well, everybody is always trying to look for edge. Edge, is a gambling and trading term. Really, just simply is that some source of either some sort of advantage that you have that your competitors don't, whether it's in your process of how you trade, your risk management system, or you have better insights, or you have better information, assuming it's legal and it's not insider trading or anything like that.
Okay.
Alternative data is one of these ways to try to get that edge. And with alternative data, I've had experience working with alternative data vendors and testing out some of this stuff. And it can, I mean, they basically alternative data is my pattern I've seen with it is that it works well at the beginning of when this thing is new and out there, but once it's spread out, not to just retail guys, but once all like the bigger institutions get it, then it just becomes part of the efficient market at a certain point.
Okay.
So like if, for example, say if people are all buying this software that does pictures of satellites at malls to see what stores people are parking at in the strip mall, and maybe somebody was able to find an alpha looking at the stores that had more cars parked near them than others, and trade retail stocks based on that. Well, if every big fund has this satellite technology access to it through the vendor, then there's no advantage anymore.
Okay.
So that's kind of the thing. It's an arms race, the alternative data, and there's not just an advantage in necessarily having more data, but it's if you can interpret it in a way that the market doesn't see for some reason or another due to institutional biases or just missing something. And that's what really I try to do, because I'm not going out and buying all the ultra expensive alternative data platforms. And sometimes I don't even hear of them. And a lot of them are, a lot of them work, some of them don't. But I try to figure out, among the data that is out there and people paying attention to, is there a different way to interpret this that has a more accurate view of the world?
Okay. So data is not everything. So
The longer your time frame is, the less that stuff matters, I would say. Like if you're trading earnings reports, they're that like in shorter term than like a quarter or less, that stuff can be very important, and not just like economic data, but things about like flows and other factors. But the longer out, I generally think the data matters less, but more on insight and how to interpret it.
okay. So um so hedge funds are investing big money on alternative data. Is it something that typical asset managers are doing? Do you think they will jump on the same trend or not, or they'll just stick to what they have?
It's just
So
whatever makes sense. Like if you can find like I have friends who are trying to start alternative data companies, and basically if you can prove that it generates some sort of additional value to the process and quantify that, people will buy it. And as soon as it stops doing that, they will not buy that. Or if it doesn't, like that's really the key. Does it help people? And it's the same with research providers, like as well as who or people like myself who more analyze data than publish it. Does the analysis or the data offer? Does it make you money or prevent or help you manage risk better so you don't lose money on bad trades? If the answer is yes, people will use it. If the answer is no, people will not.
what do you think that stands out the most? What are the things that asset management companies are looking for the most in the hiring process? What is it just marks at university or is it something else?
And are you talking about like fresh out of university, or are
Yeah,
you talking about more experienced hires? Because it's different.
fresh out of university.
Okay. Uh, like when it fresh out of university, it does help to take the CFA level one, and it shows initiative. Maybe, but depending if you have time to do it with your studies or not. But that's not the primary thing. I think now, actually, doing a lot of the more prestigious university Ivy League graduates would rather work in places like big tech than finance. It's much easier, I think, to get into our industry now than it was, say, in when I graduated from college 10 years ago. However, on the other side, due to things such as Vanguard becoming more popular and indexing, a lot of a lot of active managers are having shorter shelf lives or are experiencing risk of competition taking them out or just not raising money in the first place. This is more affecting the smaller level funds. The big ones are not getting hurt too much by this because they were able to build some momentum beforehand. But I mean, the key is one, you guys show that you have some analytical skills. A major that is either finance related or quantitative math related helps, or economics, like something that is applicable. Unless if you're working at a biotech focus, then they probably want you to have more biology background or medical background. But that's why I don't really trade healthcare stocks. So I don't really have that background. But for outside of people of that niche, it's generally an economics or quantitative background helps. I mean, if for more quantitative algorithmic shops, having coding background helps as well. Uh, and it's really just kind of about showing one, yeah, you have certain hard skills. Two, that you have some interest in the market. Like I always recommended people who have worked under me in the past or students I've mentored that they should just create like a case study. Like with either their assessment of something going on in the marketplace or the I was gonna say, oh yeah, or like their best stock pitch, long or short, and it kind of explain. Not it doesn't matter whether the performance of it, but it's more the process, like how you went to go about doing things. And yeah, getting an internship at a fund when you're in college helps too. Uh, it depending on what kind of fund you use, depending because a lot of buy-siders don't hire straight out of undergrad. So sometimes people go into banking, especially if they want a more private equity route. If you want more public markets, this type of thing, you probably have a better shot of getting in straight out of undergrad. Like, I don't really think an MBA is necessary for our profession, unless if you were working in something completely different for a while, say like you were doing corporate finance or some or random non finance related job for 10 years and you want to switch into the industry, then the CFA and MBA become a lot more valuable because it's proof of capability. And but if you try to go straight in after undergrad and have some sort of like I said, show some sort of aptitude and interest, that helps. And it's just persistence. Like I remember when I was applying for jobs, I reached out to hundreds of firms a week, like, and most of the time they're going to ignore you. And that's just part of life. And yeah, it is easier if you get, of course, if you go to a better school, but it's not a deal breaker like it was in the past.
Okay. So for those companies that don't hire people straight out of university, what are the best backgrounds for getting into asset management? What is the preferable backgrounds? Is it consulting? What is it?
Consulting is kind of like a jack of all trades thing. You can use it to transfer into a lot of different industries. Most people I know who go into consulting and exit, they want to be on the executive track for a Fortune 500 company. I mean, there are some who go into buy side, but it's not that common. Uh, I would say, yeah, maybe a corporate finance background could be it. You could also see people who work in like venture capital or private equity, but a lot of those jobs require banking first too. Sell side research or sell side trading, but in the age of automatic trading, a lot of the sell side trading is not as much there as it is like compared to what it was back when I was still in school. So that's a common path. That's how I thought I was originally going to get in the industry, is working on a sell side research firm. I interviewed with a few of them, but I ended up going a different path. And that's kind of those would probably be I'd say the past, like anything sort of in the financial industry. There's even some I know who go start in accounting and move over. It's just anything like I'd say like if you can't get one immediately on the buy side, something related to financial. There's also wealth management firms too, but those are often more sales type roles, but and marketing. So if you are going to go that way, you need to kind of develop your investment chops on your own a little bit so that people do not think you're just like a sales guy. But that's another way you could go too.
Okay, so a few minutes earlier you talked about one of the backgrounds, and if it's not economics or finance and so on, one of them could be programming and coding. Is it becoming more important to have a skill set in programming in finance and specifically in asset management?
Yeah, I mean, it is more important depending on what type of firm you work in. Data science is the other one, which
Okay.
probably is more valuable, I would say, because you don't need to necessarily be the one who's generating all the data or building the algorithms. Like, especially as coding becomes more universal skill, the real risk, I think, to a lot of the technology employment future is that due to either outsourcing or robots who can code themselves, a lot of coding is going to become a more, lack of a better term, a blue collar job like a mechanic or something that is fairly repeatable. So what's more valuable, especially as the world gets more digitally automate is the ability to interpret that data correctly and being able to have applied analysis on why something matters versus why it doesn't, because there's so much noise today. We generate more data in the last 2 years, I think, than we have in the history of humankind. That's
Okay.
kind of the world we live in now. So you got to be able to filter that. As of a quantitative background, yeah, if you're more at a quant hedge fund or a CTA or a more systematic focused firm, or a firm that has a systematic risk management process, that then yes, that stuff is more valuable. And even if you are a more traditional investment analyst, being able to test your stuff via something like Python, like your trading process, is a useful skill to have. Like, I do not have a strong coding background myself in terms of like building the algorithms from scratch, but once I had some of these systems built for me, I was able to like tinker with them and be able to make revisions and be able to run test the models in a way that I can use it without having to always ask a coder for help.
Okay, so you use these kind of systems. What are the best uses of these kind of systems? Is it backtesting or is it something else?
Backtesting is the primary use for these, for Python particularly. They also, machine learning stuff can help you, like, not just with backtesting, because backtesting assumes you know what variable you already want to test. It figures out what variables are the best ones that you want to backtest.
Okay.
So it's kind of the second derivative of backtesting is also what you would use it for.
Okay. So you tell us a bit about what asset managers and hedge funds are looking for. Can you tell us a bit more how the recruitment process works in these kind of firms? And I know from people in consulting, there are sort of like 3 rounds of interviews, behavioral interviews, technical interviews, and so on. How does that work in the hedge fund and asset management world?
It's all over the place. Some of them, like these more quantitative derivative shops that I've interviewed with, they make you take a math test online. And if you pass that, then you can have an interview. And then it's still a more technical heavy interview. And if you pass that, then they'll talk to you personally. Those are very challenging. But yeah, I mean, in terms of math skills and finance, the ones that I think are the most valued still are basic mental math, like how fast you can process something in your head, and statistics and probability. It's a real coincidence why a lot of professional poker players and sports bettors end up having later careers in finance or vice versa. It's because that level of math is far more valuable than things like, unless you're like a pure PhD level quant, than say like linear algebra or calculus or stuff like that. So I mean, in terms of math skills, it's statistics, probability, and then mental math on everything, and say like high school trigonometry and below, that you can do it without like a graphing calculator being super slow. But so that's one way. But for more qualitative ones, it's like getting another job. Like if you're a more experienced hire, recruiters will come out for you and find you via LinkedIn or other things. But for people fresh out of college, recruiters are not really, unless if you went to like Stanford or Harvard or something like that, recruiters aren't going to come for you. Depending on where you are geographically and what schools you go to, some schools will have on-campus recruiting. Unfortunately, that was not particularly helpful for me when I was in college, because I was out in Southern California at a school that's not well regarded for finance at the time. It's proved since then. So I had to be more creative and reach out to people myself. Whereas if you are at a school that is a pipeline for a lot of finance, because a lot of these employers, especially for undergrads, like to hire people who are alumni of the schools they went to. So a way to help for this is you try to search, like on LinkedIn or some other platform, who at a job that you want went to your university, if there is one. Like if you're at a major university, even like there are plenty even at my school, and it's more so now actually, because as my school's risen in prestige when I went to undergrad, um, there will find you'll find somebody, and you just ask them to schedule a time to talk to them, and then when you talk to them on the phone or in person, if they live in the same town as you, you then explain your story and tell them what you're doing and what you're looking for, and not actually direct them, ask them from a job, is seeing how they can help with them or people that they know, and you kind of work it that way. The other thing you can do is you can talk to people who do business with the hedge funds, like broker dealers or service providers, because they, or the people who sell them their Bloomberg terminals, because these people know all these people.
Okay.
They may know who's hiring. And what, so that's another way to go through it. So yeah, it's depending on your situation, it's a mix of ways that you. Does that answer your question, or am I more how to get the interview in the first place?
Yeah, that pretty much answers my question. So one other thing is, so you need to have all these technical skills, math skills, and statistics ability, but are soft skills something that you can train? Your behavior, your reaction to market movements, is it something that you can train?
Well, yeah, soft skills, I mean, they're not as important as, say, working in sales, but, and then finance guys particularly don't have the best reputation for soft skills. I think they have better soft skills on average than, say, engineers. But but the thing is you still need some. And it still is, when it's a push to shove, the tiebreaker is, would I get along with this guy?
Okay.
Like, that's kind of that's why some certain people have a harder time, because yeah, they may have the greatest hard skills in the world, but their social skills or or a cultural divide or some other variable makes it harder for them to fit in with the team. And so, yeah, I mean, and this, and also English language abilities, if you're not an American or from an English native country, is a valuable skill. Like, if you don't speak English very well, it's going to be harder, because a lot of the jobs are based in English-speaking countries, and even those who aren't, everybody in this industry, for the most part, is fluent in English.
Yeah. So what are the soft skills that you develop the most in your working experience?
Well, it's managing emotion. Like, if you're going to be a professional trader, this is like, whether you're independently or with a big company, um, managing fear and greed is probably the most alpha skill out there. It's probably more than the hard stuff, because the market's efficient partially because there's so many people who are skilled at all the hard stuff. Like, I'm saying I'm a pretty good analytical thinker, but there are hundreds, if not thousands, of people on Wall Street whose analytical skills are just as good as mine. And the edge that separates, say, the average trader and the poor traders versus the best of the best is a lot of this ability, especially if you are somebody who is not a super long-term, like Warren Buffett type, like, and you're not like a complete, like the super short-term, like high frequency, that's just more software and coding.
Yeah.
The super long-term, that's just more patience. That's a different type of soft skill, though. It's just to be able to see what the world is like, going to be like a certain amount of time out there, and being able to correct, because a lot of the validity of your hard quantitative analysis is based off of assumptions that you make. And the ability, I'm not sure if that's a soft skill or a semi-hard skill, but the ability to figure out what the assumptions you're making, whether it's for your discounted cash flow models or for just your economic analysis, are they valid, and what is the and how accurate does that assumption need to be for your analysis to be? Like, a lot of flaws is that certain investors will be overly optimistic or overly pessimistic about their assumptions built into their cash flow models. So, and depending on those assumptions, you get wildly different fair values and wildly different targets, the upside and downside. I know I've made that mistake several times before. And then, yeah, just also like if the market's down, say like 20% in a month, and a stock you're holding is down 50% in a month, do you have the fortitude to get out of the losing trade before it spirals out of control? Or if you couldn't, or if it was because of an earnings report or something more unanticipated, do you have a plan on what to do if things go against you? Or will you be afraid to buy when it's low and everybody's dumping out? Or will you be afraid to, or will you get greedy and not sell when you know that the value proposition is declined? And also, sometimes it works the other way. Like maybe when you do see something selling off a little bit, and you're like, oh no, this is just the start. You need to be able to double down when like you have a short position and the stock's down 10% from where you are, but you know that now it's just when the party's really getting started, and vice versa. Like if you're buying a stock, it may be overvalued, but you can kind of analyze the narrative and the emotion behind it, and you can realize this could keep going for a while, not take your profits too early. So there's a lot of these emotional, psychological variables, and I recommend reading a book called Come Into My Trading Room by Dr. Alexander Elder, which is kind of the start of this type of thought process.
Okay.
But yeah, mastering that takes years, though. Like I started learning about trading psychology when I was in university, and I still haven't mastered it.
Okay. Yeah, I'm done with the questions. If there's something else that you would like to share, um, I'm here for it, and thank you for your time.
Yeah, thanks for having me. Hopefully, what I'm saying is helping young people out there who are looking for jobs in finance. If you want to follow me, watch my channel, Analyzing Finance with Nick, or you can follow me at Twitter at Nicholas Pardini. Thank you for taking the time, and hopefully, I added some value to this conversation.
Okay, thank you. I'll link your channel in the description, so go check it out. Thank you for being with us. I'm Giacomo. This is Hustle Hub.